Hi, this is Jack Crooks from Money and Markets TV. The problems facing Japan have been building up for some time, and two key indicators tell me that the yen is about to take a beating. The first warning sign is that Japan just recorded its first current account deficit since 1980. The country's trade deficit last year was about 2.5 trillion yen, mainly due to higher oil costs and a slowdown in global economic growth. This deficit means that Japan will have to import capital by making itself more attractive to international investors, and that usually means higher interest rates. In addition, Japan's exporting industry is being hurt by the relatively strong yen, which makes Japanese products less competitive on international markets. As a result, many of the country's manufacturers have shifted their operations offshore, and that trend could continue unless the yen weakens. The second warning sign I'm seeing is that Japan is losing its ability to fund its huge debt load with internal savings. This is another reason that the country will need to raise interest rates to attract foreign capital. Normally, higher interest rates tend to help a currency, but in the case of Japan, the opposite could be true. Higher interest rates could actually dampen the country's growth prospects even further, and that would make the yen less attractive than its rivals in the currency markets. We've seen a similar dynamic play out in the past. When interest rates on Japanese bonds shot up in the mid-2008, the yen took a nosedive. And when interest rates fell in mid-2010, the yen's values soared. If the same trend plays out this time, the yen could have an awful long way to fall. The currency shares Japanese Yen Trust, which measures the yen against the US dollar, recently tested overhead resistance. As members of my World Currency Trader Service already know, there are several ways to take advantage of declining yen using investments in the currency and the stock markets. I'm Jack Crooks from Money and Markets TV. Thanks for watching.